George Magnus is a senior economic advisor at UBS Investment Bank. Now, George, you say, of course, that low growth, financial turbulence, and weak bank constitute a lethal mix. When is it going to actually get better? Because it seems that what's driving the markets is pure fear. When do you get out of this cycle?
Yeah, the fear about weak growth and can we fix it actually is just something that we ought to be able to deal with. And I actually think that the markets, equity markets, are probably priced in enough of what could be. It's not definite. I mean, there might be a contraction in the next 6 to 9 months. I think the odds are probably about 50-50. But this is actually more about just fear of low growth. This is about fear about nobody's running the shop.
But this is problems with growth, or also the possibility of a second financial crisis? Because if we're seeing the money markets actually freeze up again, and we're seeing so much concern about French banks, is that this is going to be another recession, but coupled on top of that with a possible financial crisis?
Yes, I think that's an additional European dimension to this. I don't think this is something which is global in the sense that it was in 2008. But of course that is a fundamental problem, but it's also about political leadership, because it would be, I mean, it's very easy for us to sit here and say, well, what they ought to do is this, this and this, and you know, if we had an EFSF that was, you know, 2.5 trillion euros, I mean, we wouldn't be having this discussion about European banks. But we don't have that, and the reasons we don't have that is because obviously European leaders they can't agree amongst themselves, and they have difficult political constituencies at home. But that's clearly where this has got to go before we can actually push the bond market crisis away a little bit.
But there's also, there's almost a political vacuum, which central banks have nicely stepped in and actually taken care of it. I know they're in an uncomfortable position, but certainly the message from the G20 when they spoke earlier in the week was, we're here, we're keeping rates low, and we're ready to act if anything happens.
Yeah, and this is part of the problem, because this is part of the continuing myth that we're in a liquidity crisis, which we are, but it's much more than just a liquidity crisis. And if it was just liquidity, then central banks ought to be able, as lenders of last resort, ECB steps in on Sunday night, it ought to be okay, but clearly it's not. And I think apart from that, I suppose people are quite concerned that actually the ECB is a very unwilling lender of last resort, doesn't really want to do
the bond
purchases.
But at least it has done it.
Yeah, well, yeah, and probably won't have the staying power to actually satisfy the requirement of the task which is at hand.
So I know it's no easy question of saying, you know, when are we going to get over these market fears? Is it going to have to get a lot worse so that governments act and actually pull themselves together and kind of, you know, stop this political impasse for it to then get a whole lot better?
Well, I'm a big subscriber to the view that actually governments have gone absent, and it's really an issue of political leadership and comprehensive political leadership, whether that's in the Eurozone or in the United States. And I don't think, I mean, Mervyn King, you showed a package before, you know, there are limits to what the Bank of England, the ECB, the Federal Reserve can do. This is not a monetary policy issue. This is really a fiscal, budgetary, governmental issue. And, you know, the prevailing wisdom for the moment is that governments either can't or refuse to act. So until we change that...
When will they act? Because, you know, in Europe, certainly we've been talking for, 2 years, is that, oh, but no, next week they'll act. Oh, next week they'll realize that the problem is huge. If we have any sort of downgrade in France, for example, which for the moment we don't have, but these countries that are now possibly at risk are so big that we won't even have the bailout money to be able to save them. So when will governments start realizing?
Well, my rather pathetic answer to this actually reflects, I think, the market's mood, which is it seems like the market has just kind of thrown up its hands and said, well, you know, who's going to do what? Who's in charge? And I think that's kind of why I feel that, you know, there's a serious risk that this malaise actually, you know, will continue to edge and chip away at market confidence. Hopefully, you know, the pressure or the necessity to act actually will cause governments to, you know, finally do the right things, but I think it's a bit like going to the orthodontist. It's a painful process.
So does it mean, George, that you're expecting certain countries in Europe to actually be downgraded before anything happens, some of the big ones?
Well, let's put it this way. I think if we have this kind of political standoff for another 3, 4, 5 months, I think there's a serious chance that the issue about ratings in Europe will become a much more pertinent issue, notwithstanding what they've said to date. But within the next 3 or 4 or 5 months, if nothing happens, the crisis in Europe actually will reach a new crescendo, and it's bound to force, I think, European leaders to have more emergency meetings and to introduce more measures. I mean, to be fair, the 21st of July measures they announced with the Brady type of restructuring proposals and the redesign of the EFSF steps in the right direction, but it's always too little too late, because the problem is much bigger than they think it is.
And so how do you actually deal with the problem? I mean, what kind of solution would you have?
Well, there are two immediate solutions, which I think are both politically anathema to the creditors of Europe and to Germany.
Fiscal union?
Well, no, I think that's a kind of a theoretical end game. I don't think that's going to happen. But I think, some inching towards that, which is a bigger financial stability facility, much bigger, and agreement about the issuance of e-bonds, about European bonds, up to a certain proportion of government issuance.
I just want to get your sense on how much this global sell-off in terms of markets can continue, because there's still good opportunities out there.
Yeah, and I think if it's just, I would quote, just a question of trying to price in the possibility of anemic growth or the risk of a contraction, mild contraction in the next 6 to 9 months, I think that the pricing in the markets actually has gone far enough. And, there is, I mean, I know this is the sort of the standard pat of your, plain vanilla equity stock strategist. There are some astounding values out there in terms of good companies, that are going to be around for a long time and so on. And they have a lot of cash. We know that listed companies are very, very cash rich and so on. So I don't think this is this is not an economic issue. At this level, this is really about confidence and about
fear.
Politics and fear. Yeah.
Are you fearful that one of the banks will go? I mean, we've had all the speculation about Société Générale. This has been categorically denied. In fact, the paper that reported on it first has now had to apologize for it. But are we going to see another Lehman Brothers type event?
I don't think so, because I think that whilst that was a big shock in 2008, I mean, a lot of things have changed. Maybe not enough, but a lot of things have changed since then. And it almost beggars belief to think that the ECB and other central banks, will be looking at this and saying, we can let this happen again. So I think, the idea that, we've got to make money available for recapitalizations of peripheral banks and secondary banks. We've got to be able to try to, make sure that money markets don't freeze up. The ECB clearly has a very, very important function to play there. The contagion goes through the banking system, but I don't believe we're going to have a banking meltdown.
Now, George, we can't forget, of course, the emerging markets, because they have their own set of problems. They're not, looking at recession or any possible downgrades, but of course they have to deal with inflation, and China's going through difficulties of its own because there's still worry of it overheating.
Yeah.
Do you believe that it's actually under control?
Inflation in China is, I mean, as far as food prices are concerned, I think the likelihood is that the official line will be realized, which is that because of base effects from last year and because of what's happening at the moment in terms of food prices, I think that the headline rate of inflation will subside during the next several months. But there's something else going on underneath there which is much more worrisome, which is the persistent rise in non-food inflation and the rampant credit creation, which is not really being tamed at all.
Yeah.
So I think there will be a premature victory call over inflation during the next few months, which is already being reflected in the People's Bank of China kind of backing away from further measures of restraint. But this just stores up a bigger problem after the new leadership change.
So are we going to see asset bubbles in China, and are we really, risking an overheating, which will mean that the economy, instead of gradually slowing, will then fall off a cliff? I
think what we've got in China is, there's a bit of an asset bubble, obviously, in the property market, which seems to have been tamed a little bit, although prices are still rising. The real problem in China is overinvestment, declining capital productivity, and a deterioration in the quality of investment financing. This is a very Minsky type of phenomenon which we saw in our own Western economies in 2005, 6, 7. But something very similar is happening in China now.
All right, George, a word of warning there from George Magnus. Thank you so much for joining us on the show.